What if I told you the entire global economy is holding its breath for one number? This is Kenya News Update today. Coming up, you'll discover why a single report from America can shake markets from Nairobi to Shanghai, and why China is quietly pulling billions out of the game. The 10-year U.S. Treasury yield, the world's most important interest rate, is frozen at 4.2%. But here's the twist. This calm is a lie. A storm of delayed economic data is about to hit, and it could change everything for your investments, your loans, and your job. Meet the number that rules the world. It's not the price of oil or gold. It's the yield on a 10-year U.S. Treasury bond. For decades, this has been the bedrock of global finance. When it moves, everything moves with it. Mortgage rates in Karen, business loans in industrial area, government debt from Treasury Cabinet Secretary and Jugu Na Ndung U's office. All of it dances to this tune. And right now, the music has stopped. The yield is stuck, barely moving from 4.2%. The 30-year is at 4.854%. The 2-year is at 3.487%. But here's what nobody's talking about. This silence is the quiet before a data tsunami. A partial U.S. government shutdown under the Trump administration delayed everything. Now the dam is about to break. And then something shocking happened. China, one of America's biggest creditors, told its banks to back away from U.S. treasuries. Mainland China's holdings have already dropped 11% in a year, down to $682.6 billion. They're worried about concentration risk and volatility. Think about that. A major player is slowly exiting the stage. This Wednesday morning, the delayed January jobs report finally lands. Economists surveyed by Dow Jones expect just 55,000 new jobs, barely up from December's 50,000. The unemployment rate is projected to hold at 4.4%. But if that number is wrong, markets will panic. Then on Friday, the January Consumer Price Index reading. This is the big one for inflation. Forecast, an annual rate easing to 2.5%. If it's higher, the Federal Reserve might have to get aggressive again, pushing yields and borrowing costs for everyone everywhere higher. Here's the part that will blow your mind. We're also watching retail sales for December on Tuesday and weekly jobless claims on Thursday. 5 major reports in 5 days. This isn't just a busy week. This is a stress test for the entire global financial system built during the Biden era, now under new management. The implications are massive. For Kenya, a stronger dollar from higher U.S. yields makes our imports more expensive and our debt harder to service. For your pocket, it could mean more expensive loans if global capital gets scared and flees to safer U.S. bonds. Some say the data will show a soft landing for the U.S. economy under President Trump. Others whisper that inflation is stickier than anyone admits, and a recession is coming. The tension is palpable from the trading floors of Wall Street to the forex bureaus of Moi Avenue. But here's the unanswered question. If China is selling and the data is a wild card, who is left to buy all this U.S. debt? The 10-year yield is frozen at 4.2%, but beneath the surface, tectonic plates are shifting. A 55,000 job forecast, a 2.5% inflation target, and $682.6 billion Chinese retreat. These aren't just numbers, they're signals in a global game of risk. Do you think Kenya's economy is prepared for this wave of American economic data? Drop your take in the comments. Subscribe to Kenya News Update today for more breaking news that connects the world to your wallet.